Thank you very much for coming to the panel on liquidity alternatives. What we're going to explore with our panelists are current themes in the trading of securities, both fixed income and equities, at speeds and at volumes that fit both investors and corporations that need to be financed. We are lucky enough, and I'm really honored to be able to present to you a stellar panel that occupies a very broad spectrum along the way to deal with this question. We have Joe Osnos from Silver Lake, who have been investors in the NASDAQ and who are currently investors in Virtu, an alternative exchange. We have Per Loven, who is Europe head for LiquidNet, which is a leading dark pool, and Per will speak about how that's defined by them. Jay Itzkovitz, who is one of the European heads for BGC Partners, the largest global interbank broker-dealer, and John Rosenberg from Technology Crossover Ventures, who have a very rich exchange technologies portfolio that contribute a lot to the increasing efficiency of trading, if you like. What I'd like to do is I'd like to ask our panelists to spend about 5 or 10 minutes each speaking about their companies and or their investments which are involved in the trading of securities and how they interplay with each other. And then the panel will discuss a few questions amongst themselves. So, Joe, if I can ask you to shoot first, so to speak, with a summary on Silver Lake.
Sure. So my name is Joe Osnos. I am one of 3 managing directors who run the EMEA geographic coverage for our firm. We are a private equity firm in terms of structure. We have $14 billion of assets under management. Our claim to fame is we do only technology. So if you go back to the 90s, you had venture capitalists who were very focused on the technology industry on the one hand, and then you had the private equity firms on the other hand that were doing really LBOs of large industrial companies. And Silver Lake's thesis was that the technology-oriented markets were maturing and that there wasn't really a good private investor to address large-scale tech. And so we are religious about investing where we think we have a competitive advantage, which are businesses that are tech and tech-related. But we're very flexible in terms of investment structure. So we've done minority investments, majority investments, levered, unlevered, debt, equity, and really ranging from investments of the size of $50 million, which is closer to what we did in the Island ECN back in 2000, to $1 billion plus per investment, which we did in Skype a couple of years ago. For us, technology is defined in 2 ways. One is the typical technology stack: hardware, software, semiconductors, IT services, comm equipment. Those are things that we've made many investments in. But more and more, we've also looked at different vertical end markets. The primary one being really financial services, where technology is transforming the way that a different end market works. So within financial services, we've made investments in different parts of the value chain. I'll touch upon them quickly here and then pass it on to the esteemed colleagues here. But in the exchange industry, we were one of the original backers of Island, which was one of the pioneering alternative exchanges in the U.S. We subsequently financed NASDAQ to buy a technology platform called iNet, and also were involved in the NASDAQ OMX merger as a minority investor. Also in the exchange area, when we owned Instinet, which was an institutional broker, it was our technologists at Instinet who started Chi-X, which has become one of the top 1 or 2 alternative exchanges globally. And then we've invested in institutional brokerage in Instinet, as I mentioned, retail brokerage in Ameritrade, more of the infrastructure side with market data, with interactive data, which we bought from Pearson's in an LBO from the UK. SunGuard, which provides a lot of the software infrastructure, and as you mentioned, Virtu, which is an electronic market maker and one of the highest volume traders on the exchange today, and a very global business. So those are just to name a few, and thank you, Osman, for having us today here at the conference.
Joe, that's very nice of you. Thank you very much. Per, over to you.
Thank you. Thank you. I'm Per Leven. I'm head of corporate strategy for Liquidnet Europe. Liquidnet is all about liquidity, and let me tell you a bit about what that means. So, if we look over the past 25 years, institutional equity assets under management have increased in value around 40 times. During that same time, if you look at what's generally is traded on lit venues, regular exchanges, alternative execution venues, so on and so forth, and take Europe as an example, that number has gone from between 10 and 50,000 euros to somewhere between 3 and 10,000 euros today. This kind of feeds the ever-increasing supply and demand imbalance problem that institutions face when they try to implement large investment decisions. This is what we're all about. We're trying to effectively help investors implement their investment decision in a very efficient way. So how do we do that? We sometimes label what's called a dark pool. A dark pool can mean many different things and cover very different varieties of activities. We really set up differently in any jurisdiction that we operate in. So let's take you through that a little bit. In the US, we are a broker that runs an ATS. In Europe, we are a broker that operates an MTF. And in many other markets of which we trade their securities, such as Turkey and Asia Pacific, we're simply a broker who facilitate trading opportunities, and then we work either directly or with local brokers to execute these on the local exchange. Now, a bit of history about the company. We're a privately founded company, privately owned company. We were founded in New York in 2000. We today trade 41 markets globally, and we operate in 5 continents. The most important thing of what we do is really coming back to trying to improve efficiencies in capital market and try to help investment managers to implement their investment decisions. So today we trade for around 700 firms globally. And coming back to how we do that and what that means, we use technology in a very innovative way in terms of creating a rather unique liquidity pool. In Europe, our liquidity pool consists any given day of around 10 to 15 billion US dollars of equities. But what does it really mean for the end investor, and what is the value we provide to the investment community? There is an independent research company called Liquid Metrics based in London, who every month gives out an overview called A Guide to European Dark Pools. And it really demystifies this concept of what a dark pool is, what they do, and the value they bring to the market. You can look at different dark pools in Europe in this guide, and you can see how they range from, on one hand, something that is very like an exchange, very in direct competition with an exchange, but also offers very little value over and above executions you can find in a lit market. That's on one side of the spectrum. On the other side of the spectrum, you have someone like us, which is really an institutional, agency-only block execution expert. According to this guide, on average, if you trade with us, you would improve your execution cost or execution efficiency with around 129 basis points. Now, that's something that has a real impact on obviously your overall transaction cost, but also directly down to the bottom line in your fund and the value you give back to your end investors. Thank you.
Per, thank you very much. Jay, over to you for an overview of BGC Partners.
Thank you, Osman. Günaydın. Burada olduğum için çok mutluyum. I'm very happy to be here. I unfortunately can't do the whole talk in Turkish, but very happy to say hello to you. BGC is a leading interdealer broker. Interdealer brokers kind of keep a low profile, so we don't usually talk at places like this. So it's unusual for us to be here. We basically facilitate liquidity between and among banks. So all the clients of interdealer brokers are dealers, meaning banks. Now, to step back a bit, BGC was spun out of Cantor Fitzgerald, which probably many of you have heard of for bad reasons from 9/11 when most of the people in Cantor were killed in New York. But Cantor was always a mixed interdealer broker and institutional broker. After 9/11, we rebuilt Cantor, and Cantor today is 5 times bigger than it was before 9/11, and part of that rebuilding was to separate the broker-dealer business, the Cantor business, let's call it, where the clients are hedge funds, pension funds, things like that, from the bank-centered business, which is the interdealer broker business. Part of the reason for that was it came from the clients. The clients of the bank clients don't want they don't want you to be their broker and a broker to their clients. So you got this split, and the way we dealt with that was to technically, literally split the two companies. So BGC today is a publicly listed company. There are only really 4 good companies that do this: BGC, ICAP, Tullet, and Tradition. There's also some laggards as well, but really the 4 main ones. So those 4 companies today are responsible for a very large portion of how banks trade with each other, and that is, in fact, the liquidity of the world. So the world's liquidity is very much running through these 4 interdealer brokers, and that's why we've been the subject of a lot of attention from regulators in the US and in the UK, and we're deemed to be systemically important, which is kind of annoying because you get a whole lot of extra regulation, but in fact that's a recognition of the fact that the interdealers of the world play a part in liquidity that's going all around the world 24 hours a day, and if we were to screw up and if we were to sort of fail, you'd have a big problem between banks finding liquidity for themselves and among themselves. The things we work in are the classic interdealer products: credit, rates, FX, commodities, derivatives, and equities. Just so to give a sense of the relative size of those, if you took all of the outstanding liquidity in those products in the world, interest rate products would be $550 trillion of outstanding interest rate products, whereas if you took the entire market cap of all the companies in the world, it's about $45 trillion. So there's much more liquidity in interest rate products. There's much more liquidity even in FX products than in equities around the world. You can see that in the Turkish market, where average daily volumes in Turkish products are 7 billion in FX and 1 billion in equities. So you have all sort. When we talk about liquidity, it really should be thought of by product. What type of product are you talking about? We think there's plenty of liquidity in the world. We just think people sometimes have trouble accessing it. We don't really think there's a need for more liquidity per se. There's just a need to get to liquidity. The way we do that with people is what we call the hybrid model, where we have lots of human beings sitting in rooms around the world with telephones. That's a very old-fashioned business that's been going since the end of World War II. That is called the voice business. Then we also have developed the electronic business. That's the future. So right now we're in a period of time where we do both, where the world depends on both of these types of liquidity. So we call that the hybrid model. And really what it means is people are on the phone connecting people to electronic systems, and people can be in their desk connecting themselves to electronic systems. We have a big mix. Cantor and BGC were pioneers in electronic trading. We were the first people to provide whole U.S. Treasury prices electronically to the market in 1972. We were the first to provide fully electronic trading of U.S. Treasuries to customers in 1999. That was eSpeed. eSpeed kind of revolutionized the U.S. Treasury market. Of course, that's the biggest liquid product in the world. So when you have massive liquidity, you need these sort of very robust massive trading systems for products like that. It's quite a bit different than equities. You're talking about trading volume in U.S. Treasuries last year of $50 trillion, a notional amount, just passing through just our system. So that doesn't mean we made a whole lot of money. We made a tiny little bit of money on that. We have a global presence. We're all around the world. We've been in Turkey with an office here since 2005. That office is primarily focused on equities because the Turkish interbank market occurs in London. So we have a very large Turkish desk in London. They're doing all Turkish bonds, government bonds, corporate bonds, FX products, but they're doing it out of London, and they're connecting people all around the world to Turkish liquidity, but through London, not through here. So the office here is focused on what's the local business here, which is equities. Taking those equities to sell around the world and hopefully bringing demand from the world here for equities. So that's what we do.
Jay, thank you very much. John, a lot of the increase in speed and efficiency and decreasing latency is enabled by the tech companies that folks like you finance. So if you could give us an overview of TCV and just a couple of case studies of their forays in this field.
Sure. Thank you, Osman. So TCV was founded back in 1995 to take advantage of the internet and in particular how it would impact traditional business models. And we've been very fortunate over the last 17 years to grow our asset base across 7 funds to $8 billion. And like Joe and our friends at Silver Lake, we're very flexible with respect to the kinds of transactions that we will do. So we will do minority transactions or controlled transactions, levered or unlevered investments. We will make primary investments into a company to support a growth agenda, whether it's acquisition support or new product development or geographic expansion. Or we'll also make just pure secondary purchases, and we'll even, in some extreme cases, venture into the public markets, where we see a value. So for us, it's that we let the transaction structure take care of itself. We really don't have any preconceived notions around what we want to achieve from a governance or an ownership percentage. And it's all about backing a growth business of scale in a market that we know really well, where we think we can add a lot of value and where we're really backing a world-class management team. So with that transaction flexibility and structure, we're actually maniacally focused on the technology and tech-enabled services markets, and gone so far as to organize ourselves by industry group within tech, and we carve it up into 5 broad sectors, which are internet and digital media, enterprise software, infrastructure, technology-enabled business services, and then, of course, as Osman mentioned, we spent a lot of time in the financial services and financial technology efforts. And just keeping it relevant to this group, when we started our financial services efforts well over a decade ago, the themes that we were pursuing was all around the democratization of trading, and it was really enabled by electronic executions and the proliferation of data. And so some of the early investments that we made, we focused actually early in the cash equities markets. We were very fortunate to partner with Per and his team at Liquidnet in the electronic institutional trading area. We also invested in an online options brokerage called Thinkorswim, which really opened up options trading to the retail investor by putting sophisticated tools into their hands. And then over time, over the course of the next couple of years, we saw that democratization effect occur in other asset classes, whether it was FX, fixed income, futures, OTC derivatives. And so we began looking at alternative business models and alternative liquidity sources, and we're very fortunate to back a company called FX'all, which is an institutional foreign exchange trading solutions and settlement services business, which went public earlier this year and was acquired by Thomson Reuters. And then in the fixed income area, we backed a business called Market Access, which enabled, again, this electronic execution of high-grade corporates. What we also learned over that time was that a lot of the market participants would need tools to better prepare them for the speed and latency challenges that they were facing, for the regulatory challenges that they were facing, for the risk management challenges that they needed to address, and also because they needed really accurate settlements and reporting. And so we spent a lot of time looking at what we called the trading solutions vendors, and that resulted in investments in companies like Riskmetrics Group, which provides middle office risk management and data solutions to buy-side market participants. We invested in Trading Screen, which is a front-end execution management system enabling multi-asset class trading and on a broker-neutral platform. And then we invested in a business, a software business in the energy market called Solark, which again was putting sophisticated trading and position management tools in the hands of very large players in the energy markets. And so we continued to spend a lot of time at this. And then, of course, in the latter half of the decade, we began to see a lot of very large non-bank financial institutions become very active in the markets. And they were investing heavily in high-frequency trading systems, and they had built pretty phenomenal businesses by virtue of their very keen investment in technology and risk management. And so we made two more investments, one in a company called Automated Trading Desk, which was a wholesale market maker in the equities and options area, and also had a proprietary trading business as well. And the other being a business that many of you may see advertised on CNBC called Interactive Brokers, which operates the Timber Hill market maker and also one of the largest and fastest growing electronic brokerages globally. So we've been spending a lot of time in these markets again over the last 10 years, and we believe that we'll continue to see very interesting opportunities as technology innovation cycles continue to accelerate, as we see a lot of cross-border trade, as we see a lot of consolidation happening. Our big belief is that all of the market participants are going to need very fast execution venues, very fast pre and post-trade risk management systems, and the settlement systems necessary to be successful. So we're delighted to accept this invitation from Osman and the exchange and the rest of the conference organizers, and I look forward to a fruitful conversation.
John, thank you very much for that. There are a few questions that occur to me about recent themes in the trading of securities where you guys are pretty intimately involved. So the first one that occurs to me is that when I look at the stats, the share of exchanges in global trading has gone down to the benefit of alternative trading venues, MTFs and so on and so forth. What would you say are the implications for exchanges in terms of how they should competitively position themselves vertically and horizontally, how they should equip themselves in terms of technology, and what should they do themselves in terms of alternative trading? So maybe I can put that to the whole panel. I don't know who would like to go first with that. John, do you want to kick off maybe?
Yeah, sure. So again, over the last 10 or 12 years that we've been doing this, we've seen this continual pattern of the fragmentation of liquidity and then the reaggregation of liquidity. And so, what you see across equities and FX and the like is that the large exchanges have had to continue to be acquisitive, not just in terms of making sure that they're preserving their flanks from a market share standpoint, but also moving into clearing, moving into other front-end systems to be able to build stronger relationships with their customer base. And so where the exchanges 15 and 20 years ago were all utilities and were run as such, now they've really done, I think, an excellent job and driven in large part by some of their competitors who sit up here and the competitive threats associated with that they've had to think more like for-profit enterprises in the last 10 or 15 years and then become very aggressive in terms of consolidation. So we would expect anyway that as these markets become more global, the exchanges will continue to look at the chess pieces in terms of asset classes, in terms of geographies, and in terms of various trading systems in order to bring that back in-house in order to stay competitive.
Yeah, and just adding on that and reflecting on the presentations that Per and Jay gave here before, one of the implications of thinking like a for-profit enterprise is being more thoughtful about who your customers are. And so I think one of the reasons for fragmentation of liquidity is that not everybody who's trading in the stock market has the same goal. Some people might be an institutional investor who's looking to move a large block of stock and do that in a way that's anonymous. And in that case, LiquidNet would be a great solution, among other situations where LiquidNet would be a great solution. In the case of a dealer who's doing a fixed income trade, clearly somebody like BGC is very valuable. And even the exchanges themselves, you've seen people like NASDAQ and the New York Stock Exchange in the U.S. create multiple venues with the same technology, actually, but with different pricing schemes to attract different types of investors. So I think that the exchanges need to think about the business model. The business model comes from who their customers are. And then there are certain specific technologies that become more relevant than they were before. So Things like high technology clearing, things like market data. It used to be the case that an incumbent exchange, it was pretty easy to generate market data and sell it because you had all the data being generated on the floor. You just package that up and sell it. Now, having technology tools that allow you to route trades to other exchanges if applicable, become that gateway, aggregate the data, are new business models for these exchanges. So those would be some of my thoughts as an investor.
Excellent. Thank you. Jay, how would you segue that into the notion of private exchanges, exchanges that exclude a certain type of investor, whether in terms of size or whatever?
Yeah, well, you see a phenomenon of closed systems, so that you have places today where only certain people are admitted to trade, and they're generally the largest people who like to trade, and they can leverage that into owning that venue. So that is something that for example, we started one like that called ELX. ELX is co-owned by it stands for Electronic Liquidity Exchange, and it's the only competitor to the CME. So the CME is effectively a monopoly in the U.S. We thought we should challenge the monopoly. Even though we're challenging it, they have 98% of the volume. So we have 2% of the volume, but the other partners in our project also trade on CME, but they trade, they're big people like Goldman and Citibank and GetGo, frequent traders. That model has been done many times in different products. I think that there's an issue as to access, but no one's really regulating that. No one's sort of saying any market has to be open to everybody. It's perfectly okay if you have a private market that you restrict to very large size players. So you'll see that. I think with exchanges, you can get back to the idea. I think there are going to be some creative things with exchanges. We've seen ICE buy Creditex. So you have the merger of an exchange with an interdealer broker. And that's a model that a lot of people think could happen again. One of my competitors could be bought by a exchange. The idea being that the human brokers on that interdealer broker will increase the volume going through the exchange by the activity of calling people up and making trades and then making them happen on the exchange. So it's actually worked quite well with ICE and Creditex, and that could be one of the next things we see.
So let me add a few things to that, some of it of which I've touched upon before, but I think it's all very, very relevant things to be discussing. So one of the main things is once we've seen the sort of evolution of exchanges from a floor-based, let's call it somewhat old-school model to a new electronic market, we've ventured into this one-size-fits-all model, which is we push all type of liquidity and all type of market players into the same electronic lit market, and we ask them to interact with each other in exactly the same way. And therein lies much of the problem. So before you used to have your upstairs market and your specialist and your floor, and there was a way to somewhat limit who you wanted to interact with, or at least sort of decide in what way you wanted to interact with other market players. And I think exchanges can do a lot in this space, and they can do it within the existing electronic framework they operate in today. We've done something with the Swiss exchange, which is effectively creating a wholesale upstairs electronic block market, whereby institutions can interact with other type of sell-side brokers, but they can achieve the size and minimize the market impact in a way that you can't do on a lit book where you have to post all the orders up front. That's important for a number of things, but one of the most important things is that it can drive IPO activity indirectly. Because what happens is, if you create a good institutional offering on exchange, that means that corporation listing at your exchange can get easier access to the type of long-term owner they seek to find. So to me, that is a very good way of achieving a two-tiered market that works for all market participants, as well as creating a very good and healthy IPO environment. The other thing to talk about, I guess, is absolutely across asset classes. Looking at Europe at the moment, not only market forces but also regulation is heavily driving a lot of other asset classes towards an exchange type of environment. That's definitely something that should be taken into consideration and acted on.
Per, thank you very much. A second theme that one reads about in the newspapers periodically are the accidents that happen. MF Global, Knight, the flash crashes, straightforward frauds like, the UBS situation, the Peregrine situation, and so on. How should we think about these events? In a sense, technology is necessary, but also creates the momentum that might increase the risk of events like this, but at the same time holds within it the methods and the wherewithal to control it even more, even better than before. So perhaps Joe and John, you can kick off on that one about the enablement and the safeguards that technology gives.
Yeah, sure. You led off by referencing a bunch of events which in and of themselves were supposed to be the 10,000-year floods, and they've happened now, 4 times in the last couple of years. Our belief anyway is that those kinds of situations have now become a fact of life because you have a lot of countervailing themes that are happening in the equities in the broader capital markets. One is the speed game, and there's now 70% of volume is currently high frequency, and these are incredibly fast computer-generated systems. There aren't people that are looking at the knowledge and the business process around them, but not actually looking at every trade. And so you've got the speed game, but then of course you have the issues around risk management and thoughtful risk management. And so everybody was really focused on running pre-trade risk through every trade through pre-trade risk. But these kinds of things can't happen everywhere, and because the markets are becoming more sophisticated, more dislocated, there are strategies that are playing one exchange versus another, or one dark pool versus another, or one asset class versus another. And so it's very difficult for any kind of regulator to say, this is how we are going to prevent systemic risk or these kinds of breakdowns. And so it's really incumbent upon, we think anyway, the shareholders of these institutions to press their management teams to really be thoughtful around how they're deploying their balance sheets every day, what kind of strategies they are pursuing. And it's hard because you're always looking backwards as opposed to looking forwards. And so you hope that you're going to catch everything. But at least for us anyway, Osman, we really believe that this is a fact of life. And so it actually creates great opportunities for guys like me and Joe because we're constantly thinking about, what systems can be put in place in order to catch this before it happens, or what triggers, systems that can be put in place to at least trip a trigger so that it doesn't run to a $400 and some odd million loss, as the most recent case may be. But it's hard, and I know that the management teams and the chief risk officers and the traders and everybody, they're trying to press the envelope from the standpoint of generating profitability, but also, that often is at the expense of, what we would all kind of classify as prudent risk management.
I think that's a very good summary. I think that technology in the markets have brought us a lot of good things, and those good things I think are highlighted by lower transaction costs and more democratization of access. It used to be that only a select few could trade and at very wide spreads. So those are very good things. And you used to have crises before as well, whether it's 1987 or 1927. Right. I think that just the nature of the crises has changed. And what you see is that the regulators are a step behind the practitioners in terms of how to regulate these more technology, more advanced markets. In fact, in some cases, it's the fact of the high frequency traders being too efficient with risk management. If you look at the flash crash and you read what the SEC said about the flash crash, it was actually an erroneous trade that was placed by a human being in a Midwestern mutual fund that just made no sense. And what happened was all the high frequency traders saw that trade and said something's wrong and pulled their liquidity out of the market. It used to be that bank runs, for example, happened by forming a line outside of a bank, and it actually took a while for people to pull the liquidity out. Now, with the technology in the market today, the line forms and people take their money out within seconds. So I think what it highlights, as John said, is really how did the regulators and the high-frequency trading firms work together. I think it's impractical and bad for the markets to just say, hey, there's these advanced technologies out there, let's not allow those to be used, and let's go back to the good old days when spreads were wide and banks were doing all the trading and, regular people couldn't access the markets. But I think it's also a mistake for high-frequency firms to pretend like there shouldn't be rules. And so one of the things that we've done at Virtu, and the name of the company is Virtu, both because Vinny Viola, the former chairman of the NYMEX, likes to use his initial, but also because we like to think that we're virtuous vis-a-vis the structure of the market, is to be very proactive and go to the regulators and say, hey, single stock circuit breakers, great idea. Let's make sure that we put those into place so we don't have these big confidence-shattering events. Or you want to take a look at our code? Absolutely, open kimono, we'll walk you through it. And even in some cases give tools to the regulators they can use to more effectively catch up with the people that they're regulating. Which, by the way, this happens in every industry. Unfortunately, the regulators of the airline industry are always behind the airlines in terms of innovations. But I think if there are people on both sides of the table who are well-intentioned, that you can come to a solution together.
Joe, thank you very much. I'll get to the regulator in just a moment, but just before that, if I could ask Per and Jay, so on the rock face, how does one try to make as sure as possible that these sorts of things, their probability is minimized? How does one empower the risk officer, etc., etc.? Jay, do you want to kick off on that?
Yeah, well, the way you empower him is you make it in the company that you can't overrule him, and you can't try to influence him. And we've spent a lot of time building up the risk department's profile so that it's taken seriously. It used to be considered the worst place to work and the worst, job in the firm, and now it's a very powerful job in all these firms. It's a very important job. Each of the four recent problems that we've had in the markets are actually, if you break them down, they're all for very different reasons. So Peregrine was just a fraud. That was just a criminal fraud. And there's very little, I think, exchanges or brokers or liquidity providers can do when someone is engaging in a detailed fraud. MF was a bad trading idea that got out of control, and then there was probably some bad behavior right at the very, very end. But the idea occurred a year before, and it as it played out financially, it led to an underlying problem. Knight was a technology problem, and some kind of technology problem that I'm not sure anybody really knows what it was exactly, but they seem to have figured it out. So there was no fraud, there was no bad behavior, it was just bad luck, bad technology, bad luck that hadn't been properly vetted. UBS was criminal or semi-criminal. So, you have all sorts of different problems that occur, and they occur for different reasons. And I think our job is to, as you said, work with the regulators and sort of be cooperative with them and try to do the best we can. But I don't think there's a miracle cure for bad human behavior.
Right. Per, anything you'd add to that one?
Yeah, I mean that's a distinction that is very important to make. Is we talk on one hand about technology malfunctioning or technology glitches, and on the other hand of human illegal behavior. You have to deal with those issues in two very, very different ways. Empowering the risk officer, the risk management function, absolutely. I don't think there's a financial firm in the world that hasn't done that over the past 2 years. I mean, just looking for us, we've probably gone from around 5% to 15% of our staff being in risk and compliance functions. And take into account we're an execution-only agency broker, then multiply that into more of a prop trading scenario, and you can do the math. But coming back to the whole technology thing, So markets are so fast today that if you do make a mistake, it's going to hurt you in a way that it just didn't before. You can't roll it back. It spirals out of control. You've invested a lot of time, skills, and technology into getting to that point. I think the regulator's role is somewhat discussing with firms engaging in this activity to make sure you actually invest the same amount of time, skills, and efficiently to have the adequate risk functions going alongside with this. If you created an algo, then you can also create a function that can control and detect that algo, in theory. And I'm not sure that people have focused as much on that side of thing. Well, they haven't for obvious reason. It's the least commercial part. So that's, I think, how to deal with the technical side of it. Also, I think execution venues globally, be it alternative venues or exchanges, has a very important role to play. We've created an avenue to trade in a way that you can do today, maybe without having considered that there is a responsibility in offering those avenues. Has to do with circuit breakers, has to do with how do you vet what firm you allow into your venue and on what basis. It has to do with things like leverage and capital adequacy and so on and so forth. These are all things regulators are looking at. Unfortunately, it's not happening fast enough. But everyone in this game have a responsibility.
Thank you very much, Per. A case study of a situation where the regulator exchange partnership or dichotomy, if you like, works efficiently so that things are not too restricted, but they're also monitored and caught as much as possible in time. Any case studies that occurred to you guys, and maybe Brazil? Let me throw that out to all of you.
I'll talk about that because we operate maybe the #1 wholesale broker in Brazil, which is called Likidite, and I bought it for our company. I've been very, very happy with it. I think the reason it works so well in Brazil is not just because the regulator is quite good and professional, but because the underlying market architecture is excellent. So they have a unified futures and equities exchange.
Right.
That means that it's technologically unified, and that creates an environment where the regulator has a lot less stuff to worry about than in the US or internationally. So the regulator is not really worrying about a whole raft of things. Once you have a centralized clearing party, which is the exchange, everything else falls into place, and the regulator doesn't have to worry about excess distracting things, and it can worry about sort of, is that person qualified to do what they're doing? Are they doing it right? Are they properly staffed? Are the people correct? Are the people have the right training, the right background? Another added benefit of that structure, of course, is that it's a low capital structure, because the exchange becomes a centralized clearing place. You put up some money, but in Brazil you can actually borrow a lot of that money, or you can have it put up by way of a letter of credit. So once you have a very centralized system, the banks actually can finance the market structure. The brokers can kind of sit there and go, I do what I do, I connect people, and then I just put those trades into an exchange that functions very nicely. You eliminate a lot of friction with that kind of system. So I've been a big fan of that, of their system.
Thank you very much, Jay. Any comments from the rest of you before I open it to the floor on the regulator exchange partnership, if you like? So, questions, thoughts, reflections to the panel from the audience. Sir.
US government funds, I think, wasn't it, at that time?
Guys, would you like to address that? that one? Who'd like to take that one?
Yes, you've got JP Morgan are now under investigation in electricity trading. Again, managed by senior people who apparently know what they're doing.
John used to be a banker, so he'll take it.
Right, excellent.
You know, when you're thinking about risk, right? There's market risk, there's credit risk, and then there's the operational risk, and then of course there's the calculated risk that one would take to trade their proprietary book. And I think there are flavors in terms of what a proprietary book means, right? Because the large banks, they view themselves as intermediaries, as facilitators for a more natural and liquid market, but at the same time, they are taking directional positions on certain bets based upon the information flow that they are seeing, globally. So it would be tough for me to comment on J.P. Morgan in particular, but what I would say in all the situations that we've talked about, at the end of the day, you are buying and selling an instrument, and whether you own that instrument for a nanosecond or whether you own it for a day or a month or a year, there is some risk of carry. And so you hope that the traders are sophisticated, they're seeing good information, the risk managers understand what the parameters are by which they operate and they're investing. But it's very hard, when you have something, like the J.P. Morgan situation, which relative to the broader balance sheet, it's very small until it shows up in the P&L, right, as a loss. So I don't, again, it's at the end of the day, these are all people making decisions, and banks and financial institutions and non-bank financial institutions all have their own strategies around, how they want to pursue these things. And so again, we've talked a lot about what you're going to do from a risk standpoint, but I think it comes down to people, and it comes down to what the overall objectives are of the institution and how they want to put their balance sheets to work to make money, whether it is in a more proprietary way or more in a facilitation way. But between points A and B, there's a lot of area that again, some will choose one strategy and some others.
But I think just to add to that, I think that's actually one of the examples that regulators are dealing in an intelligent way around. Because if you think about what's happened there, so you can have a firm who deploys its own capital to take investment decisions, and you can limit the leverage they can do, you can limit the damage they can do to themselves, right? And that to some extent is happening. But at the end of the day, a company can make their own investment decisions. They are allowed to play with their own money. They can only lose their own money at the end of the day. The problem comes when they are coupled together with a bank doing other type of activity, and suddenly you bring down the whole house. And that's really where the issue lies. And there are sort of signs that we are tackling that in terms of decoupling proprietary entities from more kind of commercial banking activity or credit type of activity. And I think that's the way to go. That's the way you have to go, because you can never stop people from losing money, but you can stop the ripple effect.
Yeah, I think from a technology perspective, it's actually a very different type of problem as well to ferret out that type of loss position. We've talked a lot on this panel about the trading-oriented, capital markets-oriented, externally facing technologies that people have deployed. And those types of systems tend to be low latency, high transaction throughput, but relatively simple software programs. So it's actually not that hard to build a matching engine for a stock. I've actually built one personally. It wasn't very good, but it's not that hard to do. When you get into the back office of the banks, it's a different type of problem, which is that you're not dealing with speed of calculations, you're not dealing with technology, you're just dealing with massive amounts of data. You're dealing with often legacy systems that have been put in place over 30 years. In some cases have been acquired when banks acquired other things. And you just end up with a real I think John used the term operational risk. It's more of a problem that would be more akin to an industrial manufacturing company that had an accounting mistake because their systems, their SAP system didn't work properly, than it is something to do with the flash crash. But people, I think in the press and in the popular society kind of associate them with losing confidence in the banks. But what I would say is we have a lot further to go, I think, in the back office IT of the banks than we do in the markets in terms of having a modern architecture. And we've invested in companies like SunGard and Interactive Data, who are doing specifically those types of systems. So I view that more as a management system issue as opposed to a capital market systems issue. It's actually surprising, I'm sure you guys would agree, to see what type of systems even the best banks use for risk management. I mean, it's very rudimentary still. And even having the CEO of the bank or the board of the bank see what the positions are, let alone what the analysis is if they move, it's something that a lot of banks are, believe it or not, still working on. They don't even have an aggregated view in a lot of cases. So there's a lot of investment that needs to go into that, and I think there's opportunities for vendors to make that market better.
Thank you very much.
Just to jump in on that, it's an absolutely valid point. I know for a fact that there are many houses who simply cannot get an aggregated view of risk across asset classes, at least not in real time or close to real time. Now, exposure is always across asset classes, so if you can't solve that problem internally, you don't know what risk you're having at any given point in time.
Maybe time for one more question from the audience, and then I think lunch awaits. Go ahead.
Dr. Darman from Turkey. Well, thank you. I don't know whether it's directly the right place to ask, but I was in Paris last July, and I participated to the Paris Fund Industry Europe organized by the Europlus Paris. And there was a lot of emphasis given to the bond issuance by the SMEs on the way to recovery from the financial crisis. Do you think it is feasible in terms of transparency, risk management, and also from the practical side? Because there was a lot of concern from the audience, the participants, regarding the possibility of being it successful. Because, you know, it's hard to get right financial statements, it's hard to get to regulate it. How would you comment on that? I mean, anyone from the speakers.
Thank you very much. So if I could summarize it, it's the question of corporate bonds for smaller companies, basically, how to issuance, liquidity, and so on. Guys, let me hand it over.
Yeah, I mean, I personally think there is a big opportunity in mid-market lending in Europe, because what you're seeing is that the big banks, because of the crisis, are pulling back. And the easiest way to pull back is for the smaller customers, rather than letting down their biggest customers that they've known for years. So then the challenge becomes, how do you credit risk manage a lending of a smaller book, or a book comprised of smaller institutions. I think I'd give you a couple of answers to that. One which is high tech, and one which is very low tech. I'll take the low tech one first, which is being close to the customer and being local. One of the things that happened in the U.S. in the mortgage market was that, banks that used to lend to small businesses and to housing developments locally sold those off into bigger pools of larger banks. So they didn't really have to do the credit analysis themselves, because they weren't planning on holding the securities. That was great from a perspective of diversification, because no regional bank would be too tied to the local economy. But it was actually very bad in terms of fundamental credit underwriting. So I don't think there's a one-size-fits-all, and I do think that business model would be different by geography. The second thing I'd say is that there are some pretty innovative technology-oriented ways to lend to small and medium businesses, ranging from, I'll just give you a few of them, internet-based lenders that use things like people's behavior on the internet to decide whether to supplement credit data to see whether they're credit worthy. So a small medium business that immediately goes into the website and puts the maximum amount of debt that they could borrow is rejected, for example, at the extreme from a credit decision. And then there's also, I think, alternative sources of data as opposed to just the big, accounting financial statements that can be used in small medium business lending. One example is we have a credit card processing company in our portfolio, and a lot of times our merchants, these are restaurants and dry cleaners, they need loans and they can't get them from the banks. Well, it turns out that since we're the credit card processor, we see all of their revenue every day coming through the credit card machine. So That's a source of data in this kind of internet-enabled world that we can ingest and create our own credit analytics and help to capture a market that's probably being underserved by the traditional larger banks.
Other comments on corporate bonds, maybe? Well, it only remains for me to thank you guys very much for having really shed very precious and fruitful light for all of us on the topic of liquidity alternatives and the historical themes and the prospective themes going forward. Thank you very much for coming all the way out here to share these views with us, and I know that we've all benefited from them. Thank you very much, guys.